Today, we are going to tackle one of the most fundamental concepts in all of finance, a principle that governs everything from your personal savings to multi-billion dollar corporate decisions. We are talking about present value. We'll start with a simple question, break down the core formulas, visualize the concepts with Python, and see how this one idea is used everywhere in the financial world. So let's get started. Let me ask you a simple question. Would you rather have $100 today or $100 one year from now? I'm willing to bet you said $100 today. This simple preference is the foundation of time value of money. The idea that money you have right now is worth more than the same amount in the future. There are three key reasons for this. The first one is opportunity cost. Money you have today can be invested. A dollar today is like a seed you can plant to grow more money. And the next reason is inflation. Over time, prices tend to rise, meaning the purchasing power of your money decreases. $100 buys more today than it will next year. And the last reason is uncertainty. A promise of money in the future isn't a guarantee. Money in your hand is certain. Present value or PV is the tool that lets you calculate exactly how much a future sum of money is worth in today's terms. The process of finding the present value is called discounting. You're discounting a future value back to what it's worth today. The formula for a single future payment is beautifully simple. Present value is equals to future value by 1 plus r to the power of n. So PV is the present value or what the future value is worth today. And FV is the future value or the cash amount you will receive in the future. And R is the discount rate. This is the most important piece. It represents your required rate of return or opportunity cost. If you could earn 5% in a safe investment, your discount rate is 5%. For riskier promise, you demand a higher R to compensate for that risk. Now let's make this concrete with some code. First, we'll look at a single cash flow. So our question is, what is the present value of $1,000 to be received in 5 years if our discount rate is 8%? So in this snippet, we defined a function called calculate PV single, which takes in the future value, the rate, and the number of years, and plugs these parameters into the present value formula and returns the result. So we put the numbers in the question into a function which applies the formula, and then we get the answer. So if we run this code, the answer for the present value of $1,000 in 5 years at an 8% discount rate is $680.58. This means that given an 8% annual return opportunity, you should be indifferent between receiving $680.58 today and receiving $1,000 in 5 years. Now let's visualize how much the discount rate and time affect the present value. We'll plot the present value of $1,000 over 30 years for several discount rates. So here the rates we took are 3%, 5%, 8%, and 12%. So for each rate, we calculate the PV here and visualize how these PVs move with the rates and the time periods. So let's run this code. Now look at this chart. The blue line at the top is a low 3% discount rate. After 30 years, the $1,000 is still worth over $400. But look at the red line, a 12% discount rate. Just after 10 years, the present value is already less than 350. And by 30 years, it's worth less than 50. This powerfully shows that the longer you have to wait and the higher your opportunity cost, the less future money is worth to you today. Now, what if you're promised a series of equal payments over time, like a lottery payout or a pension? This is called an annuity. We can find the present value of the entire stream of payments with a single formula. So this is the formula for calculating present value of an annuity. So present value is equals to C into 1 minus 1 plus R to the power of minus n whole by R, where C is the amount of each cash payment. Let's use the lottery winner's choice analogy. Imagine you win the lottery. They offer you $1 million in cash today, or $50,000 a year for 30 years, which totals to $1.5 million. Which is the better deal? You can't just compare the raw numbers. You have to use the present value of an annuity formula to find the today value of that 30-year stream of payments. So let's run a similar example. What is the present value of receiving $10,000 every year for 20 years at a 7% discount rate? So we defined a function called calculate PV annuity, which takes in the parameters each cash payment, the rate, and the number of years, and calculates the discount factor, which is this, and returns the present value of the annuity. So let's run this snippet. So the present value of receiving $10,000 every year for 20 years at a 7% discount rate is $105,940. Even though the total payments add up to $200,000, the value in today's money, given a 7% opportunity cost, is just over $100,000. So now that we understood how we calculate present value, let's look at where present value is actually used. This isn't just a theoretical exercise. Present value is one of the most critical and widely used tools in all of finance. So, the first use case we'll look into is capital budgeting. Companies use it to decide if building a new factory is a good investment by comparing the present value of future profits to the initial cost. This is called the net present value. The next use case is bond valuation. The price of a bond is simply the present value of all its future interest payments plus the final principal amount. The next use case is stock valuation. The famous discounted cash flow or DCF model values a company by estimating all of its future cash flows and discounting them back to today. And the last use case is personal finance. It is used for everything from calculating your mortgage to figuring out how much you need to save for retirement. So, present value is the engine that drives the value of money. It provides a rational and consistent way to compare cash flows from different points in time on an apples to apples basis. By understanding how to discount future sums back to present, you gain a powerful tool for making smarter financial decisions, whether you're investing for future, taking out a loan, or running a global corporation.